Welcome to today's market report.
World shares fell on Friday, pressured by concerns over China's markets, the potential for a US corporate tax hike, and an update on the US Federal Reserve's tapering strategy next week. The US 10-year Treasury note yield rose to touch a 2-month high in early US trade, and the dollar touched a 3-week high. MSCI's gauge of stocks across the globe shed 0.58%. The Pan-European Stock 600 index lost 0.82%, while MSCI's broadest index of Asia-Pacific shares outside of Japan closed 0.13% higher. Shares in embattled property developer China Evergrande, which has 2 trillion yuan in liabilities and faces an $80 million bond coupon payment next week, dropped 30% this week. The editor-in-chief of state-backed Chinese newspaper Global Times warned Evergrande that it should not bet on a government bailout on the assumption it is too big to fail. The underlying risk for markets is if Evergrande is not bailed out by the Chinese government. According to HYCM, I don't think Evergrande is a layman scenario. It is not going to be a massive systemic risk. In the US, concerns grew that the potential hike in corporate taxes could eat into earnings as leading Democrats and President Joe Biden fought to raise the top tax rate on corporations to 26.5% from the current 21%. The Federal Reserve, facing a labour market that may be stalling or on the cusp of a surge, is expected next week to open the door to reducing its monthly bond purchases while tying any actual changes to US job growth in September and beyond. Historically, the Fed awaits for data to take a course of action. According to Wilshire Phoenix, we have seen quite a few months of high inflation data. We're waiting for a response. The Dow Jones fell 0.52% to 34,570. The S&P lost 0.76% to 4,439. Nasdaq dropped 1.01% to 15,028. Stock market prices were expected to be erratic on Friday due to quadruple witching day, when 4 different futures and options contracts expire. The yield on benchmark 10-year Treasury notes was 1.3753%. The yield on Germany's 10-year government bond, the benchmark for the Eurozone, was at minus 0.28%, after rising as much as 3.5 basis points to a 2-month high of minus 0.27%, after a Financial Times report suggested the European Central Bank expects to hit its 2% inflation target by 2025. Stronger than expected US retail sales data on Thursday boosted the dollar, which held steady near the previous day's 3-week high against an index of currencies. Oil prices fell on Friday as energy companies in the US Gulf of Mexico restarted production after back-to-back hurricanes in the region shut output. Both Brent and the WTI were on track for weekly gains of 3.2% and 3.3% respectively, owing to the recent supply tightness due to the hurricane outage. Brent were trading at $75.25 per barrel. WTI was at $72.01 per barrel. Gold futures dropped 0.33% at $1,750.85 per ounce. On the FX front, GBP/USD is sliding in American session to new weekly lows, trading at 137.54, down 0.26%. As we approach the London fix and head into the weekend, we could expect some downward pressure on the back of the dampened market sentiment. The market sentiment is downbeat. US stocks are losing ground following the European trend, and bond yields rise as investors turn cautious on the global economic recovery amid worries about Delta strain and risks from China. During the European session, the Office for National Statistics reported that retail sales shrank 0.9% in August, worse than the 2.5% gain year-on-year foreseen by economists. This negative data adds to concerns about economic recovery, albeit sales volumes remain above pre-pandemic levels. The University of Michigan consumer sentiment rose to 71 in September, a tick lower than the 72.2 expected by analysts. Eurodollar turned negative around 170.60 after hitting fresh daily tops in the 117.80 region, while the US 10-year Treasury bond yields come back to the key 200-day moving average, pushes the dollar index near to 93.
This is today's market news. Thanks for listening. We'll see you next time.